Hi, welcome to Introduction to Auditing and Assurance Services. Our objectives will be: the audience should have the idea of assurance engagement and audit engagement, know the parties involved in the assurance and audit engagement, learn the different levels of assurance, and have the idea of different assurance engagement report. Lastly, we will have to explain expectation gap. When you talk about assurance services, it is where the engagement practitioner expressed conclusions designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of evaluation or measurement of a subject matter against criteria. These criteria can be the accounting standards or any requirement from government which, shall we say, sets the standards to test the subject matter. In audit, it will be the financial statement, and it will provide degree of confidence to intended users. The intended users can be stockholder or shareholders, government, investors, or banks. So as I mentioned, that degree of confidence, that is the trust that the intended users can have with the report. When you talk about criteria, those are standards or rules used by the responsible party or the one preparing the report, and in which the practitioner will test and evaluate whether they complied with the set criteria. There will be three parties involved in assurance services. The first one is the responsible party. He is the one, or they are the one who are required to prepare the report for the use of other party. Practitioner is the one who reviewed or audit the report prepared by responsible party and provides their conclusion with regards to that report. Intended users are the ones who are using or waiting for the report coming from responsible party, which is audited or reviewed by practitioner for their decision making. The subject matter is the report prepared by the responsible party. As I mentioned, if it is a financial statement audit or assurance service, the financial report is the subject matter. Conclusion, of course, is the final result of the engagement. And the best example of assurance services is audit. So let's talk about financial statement audit. Financial statement audit is an engagement designed to express an opinion about whether the report is prepared in all material respects in accordance with financial reporting framework. Again, it has the purpose of enhancing the degree of confidence of intended users in the financial statements. So if there is a third party independent of the process reviewing the report, it provides certain degree of reliability towards the report. And the auditor will express their opinion whether the financial statements in all material respects in accordance with financial reporting framework. So when you studied your financial accounting and principles of accounting, you may have discussed about international financial reporting standards. So that is the internationally recognized financial accounting standards, which is used by the responsible party in preparing the report. So the overall objectives of the auditor is to obtain reasonable assurance that the financial statements are free from material misstatements, and to report on financial statements and communicate as required by the international standards on auditing in accordance with auditors' findings. Okay, when you perform your audit, we have to be possessing this attribute, professional skepticism. The auditor shall plan and perform an audit with professional skepticism, recognizing that circumstances may exist that cause the financial statements to be materially misstated. Professional judgment, on the other hand, is where the auditor exercises professional judgment in planning and performing an audit of financial statements. It should be noted that when you talk about professional judgment, it may vary between the seniority, maturity, and experience of the auditor. So, generally, a much experienced auditor will have a much better judgment with regards to audit work. So when we talk about sufficient appropriate audit evidence and audit risk, to obtain reasonable assurance, the auditor shall obtain sufficient appropriate audit evidence to reduce the risk to an acceptably low level and thereby enable the auditor to draw reasonable conclusion on which to base the auditor's opinion. Let's talk about different levels of assurances. The first one is reasonable assurance, followed by limited assurance, and lastly, no assurance. An example of reasonable assurance will be audit engagement, while limited assurance will be review engagement. No assurance example will be compilation and agreed upon engagement. If you have heard some audit firms offering bookkeeping, that is what we call compilation. So it's under the no assurance. So reasonable assurance, the objective of reasonable assurance engagement is a reduction in assurance engagement risk to an acceptably low level in circumstances of the engagement as the basis for positive form of expression of practitioner's conclusion. So in this regards, when you talk about reasonable assurance, that will be the highest assurance that an assurance practitioner can provide. In assurance engagement, there is no such thing as absolute assurance because there are inherent risks in your work. So what you will do is to reduce that engagement risk to what we call acceptably low level. To reduce that, you must have proper planning and choose the right strategy. We will talk about it for reducing the risk to an acceptably low level on audit planning. Limited assurance engagement. The objective of the limited assurance engagement is a reduction in assurance engagement risk to a level that is acceptable in the circumstances of the engagement. But where the risk is greater than for a reasonable assurance engagement as the basis for a negative form of expression of practitioner's conclusion. Now you can see the difference between reasonable and limited assurance. And in reasonable assurance, there's a positive form of expression of practitioner's conclusion. It happens where if you already chosen the appropriate strategy and you have a wider scope of work, and also the purpose is to obtain a much higher level of audit evidence. While in limited assurance, there are some limitation on the nature, timing, and scope of the work. So just to add on, when you talk about reasonable assurance engagement, most likely this will be for 1 year or one accounting cycle. While limited assurance can be done half year, or the coverage will be half year or quarterly. And no assurance is quite simple. Practitioner does not give or provide assurance on the engagement. The reason is because they are just compiling report and getting or following the instruction provided by the responsible party. Okay, just some points on review engagement. So it would not require all procedures necessary for audit. So if audit requires reperformance, recalculation, external confirmation, under the review engagement, it doesn't require to perform that. But both review and audit engagement will need to perform observation, certain inspections, and some analytical procedures. Obtain sufficient appropriate evidence primarily through inquiry and analytical procedure. So when you say negative assurance, it provides only moderate assurance. On the basis of procedures which do not provide all the evidence that would be required in an audit, anything come to the practitioner's attention that causes the practitioner to believe that the financial statements are not prepared in all material respects in accordance with the applicable financial reporting framework. Now, the final product of the audit will be what we call audit opinion. We have two types or two major classifications. The first one is unmodified. When you say unmodified audit opinion, it is where the financial statements are prepared in all material respect in accordance with applicable financial reporting framework. You've seen and heard the in all material respect phrase. So we will use certain materiality concept in doing the audit. So you may have learned this in your principles of accounting, the concept of materiality. It will be the same here. Now, under modified opinion, when you say modified, you have certain qualification or observations that you want the readers of the report to know. So under modified opinion, there will be it may not be free from material misstatements, or the auditor is unable to obtain sufficient and appropriate evidence. So if there are limitations or restrictions imposed to auditor, or the auditor has faced, that also will create modified opinion. In short, unmodified opinion, so unmodified opinion is a clear opinion, or we call it the standard report. Modified opinion, you want to emphasize something, or you want to the reader to know that something may not be right in the presentation of the report, or you don't have much information to conclude your report. So unmodified, we have two sub-classification. We have unqualified opinion and unqualified opinion with emphasis of matter. Under modified, we have qualified, and extreme cases we have adverse and disclaimer. Okay, coming back to that material concept. When an item or items or events will be material, it has a significant effect on your decision making. When we see the word pervasive, it's prevalent or persistent item or items or event that affects the financial statement as a whole. So if we want to compare these two, When you talk about material, it may affect only one or two line items in the financial statements, while pervasive can affect the whole financial statements. Now, under review report, the review report should contain a clear written expression of negative assurance. The practitioner should review and assess the conclusion drawn from the basis obtained as the basis for the expression of negative assurance. Based on the work performed, the practitioner should assess whether any information obtained during the review indicates that the financial statements do not give a true and fair view in accordance with applicable financial reporting framework. Now, what is expectation gap? Okay, so expectation gap is the difference between the expectations of assurance providers and the financial report or other users. So sometimes the auditor may have expect that the preparer of the financial report knows how to prepare and present the report, while the responsible party preparing the report may have expected the internal or the external auditor that they are the responsible party to prepare the report. So this creates expectation gap. So how can we reduce that? Okay, first is, as an auditor, we have to perform our work appropriately, and we have to educate the public what is the purpose of audit, have a clear understanding of work of the auditor as well as the preparer of the financial report. That is why we have what we call engagement letter. The engagement letter is like a contract between you as an auditor and the client. When you say client, that is the company. So in that engagement letter, it will be specifying what will be your responsibility as an auditor and what will be their responsibility as a client. And also, we can enhance reporting. Nowadays, we have what we call key audit matters, which is included in the audit opinion. It actually clarifies what are the things that the auditor have discussed with the client, so others will be clear on what are the things that we are doing as an auditor. And that's it for my presentation. You can refer your work to ISA 200, 700, 705, and 706, ISRE 2400. These are issued by International Auditing and Assurance Standards Board. Thank you.